Hello everyone, and welcome to the new episode of Learn and Trade with Popeye. Today's topic will be risk management. So we will try to understand what is risk management, why is so important, and what is the daily application and the rules you have to try to follow in order to maximize your risk management trading strategy and avoid blowing up all your accounts and your capital. It's a super important topic, so make sure you stay with me until the end. A big shout out to ZoomeX, that is the sponsor of this video. Make sure you trade with me on ZoomeX. You will find my referral link in the description below the video to get you a 20% discount on trading fees. Before moving to the lesson, make also sure to subscribe to my channel, leave a comment and a like, and have this notification on. But without further ado, let's go to see and to understand why risk management is so important. So basically, while trading or investing in general, all you have is your capital, and your capital is what allows you to stay in the game. Without capital, you cannot trade, you cannot invest, you cannot do anything. So it's very important that you protect as much as possible your capital in order to be able to participate in the market as long as you want. So in this chart here, you can see what happens whenever you lose a percentage of your trading capital and the percentage of gain that you need to have in order to recover the loss you had. So to make it very straightforward, if you lose 10% of your capital, you will need to win or to gain 11.11% to go to break even. As you can see, these numbers are exponential. The more you lose, the more your capital becomes smaller, the more you will need to win and to gain in order to go back to break even. To give you the example, if you lose 50% of your capital, you will need 100% gain to go back just to break even. And if you lose 90% of your capital, so let's say that you start with an account of $1,000 and you burn $900, if you remain with $100, you will need to win 900% to gain 900% to go back to the initial, just a break even, to the initial 1K you had at the very beginning. That's why it's very important that you focus much more on avoiding losses and reducing losses than to focus on gain. Because if you consume and destroy your capital, it will be very difficult, if not impossible, even to go back at break even. So reducing losses is of paramount importance whenever you want to start the endeavor of trading. This is another example, another chart table important to understand is whenever you risk a percentage, what it changes whenever you risk 2% on a single trade or you risk 10% in a single trade. So if you see here, the total account, the starting balance is in both cases 20K. If you risk 2% on every trade, you can lose 10 consecutive trade, and at the end you will have $16,000. Even if you lost 10 consecutive trade, thanks to the fact that you have been risking only 2% for each trade, you end up with a $16,000 account. If you risk 10% on every trade, with the same 10 losses in a row, you will end up with just $7,000 in the account. So while trading, we never know if our trade is gonna be a winning trade or a losing trade. We always have to start with the premises that we might lose, or we probably will lose, and we probably will lose consequentially for many times. This should always be your your premises and your initial thesis. So as you can see, the more you risk on each trade, the more you will erode and destroy your capital, and in the end you will remain with much less than what we started, and to recover, just to go back to break even, it will be extremely difficult, and then you will be forced to start to gamble and blow up account and get liquidated. So these two tables allow you to understand why it's so important to be disciplined, why it's so important to apply risk management in order to protect your capital. Your capital is the only tools you have to be active and to participate in the market. So moving to the next table, this is very simple. Simply put, what gives you the definition of risk reward. So risk reward is whatever you are willing to risk on a specific trade comparing to the reward you will be getting on the same trade. These are some example of win rate along with the risk reward. As you can see here in the left column, it gives you 1-to-1 risk reward, so means that you are willing to risk $10 to win $10 or risk 1% to win 1%, while in the last one there is the risk reward of 5-to-1. 5-to-1 means that you are willing to risk $10 to be rewarded or to win, so your trade to win $50, or to risk 1%, and in case you go to full TP, to full take profit, to win 5% of your account. This is the win rate. So with a 5-to-1 average trade taken in risk reward, you will be profitable even with a 20% win rate. And as you can see moving here, with a 1-to-1 risk reward, you will need to be profitable 60% of the time. Simply put, in a 1-to-1 risk reward, since you risk 1 to get 1, if you have a win rate of 50%, you will end up break even, because all the time you win 1, all the time you lose 1. So if you have a 50% win rate, at the end your account will be even. So these three concepts are very important for everything we are gonna talk later on. To make it super straightforward and simple, this is what a trade look like, and you can see here the risk reward is given usually here in the middle, and this example of this trade is a trade where we are risking 5% to gain potentially 15%, and the risk reward in this case is 3, so would be here. This sort of trade usually is considered the 1-to-3 risk reward, 3-to-1 risk reward, one of the common basic. Usually they say try to avoid to be lower than 2 risk reward. The 3-to-1 risk reward will allow you to be profitable more or less with a 30 to 40% win rate, because every time you lose 1, but every time you win, if you go to full TP, you will win 3. So trying to put all this concept to practice of what you have to do whenever you want to open a trade, and this goes to the many questions, how much leverage you use, on all these questions that are really not relevant. All that is relevant is the position size. So I will try to give you the specific example. Let's say that you trade with a $10,000 account. We will use as a general rules, then we will explain it a little bit better, the 1% risk per trade. So if you have a 10K account, you don't want to risk, let's say this is the textbook limit for risk, then we will see how we can change or adapt this. You don't want to risk more than 1% for every trade you take. So meaning that the value risk that you will have for each trade is $100. That is the 1% of the 10K account. If you take on average 3-to-1 risk reward trades, your take profit will be $300. That is the 3% of the $10,000 account. So let's try to imagine that we take this trade. that I put it here. So it's a 3-to-1 risk reward trade where the stop loss is 5% and the take profit is 15%. So we expect the price of Bitcoin to do something like this, get us fill, go here and take profit here. If we go down here, we will lose 5% of the account, 5% of the position, and if we go up here, we will get a 15% reward. So what does it mean in practice, this trade on this 10K account? Will mean that if we played spot, in order to respect our rules, we need to do this calculation. Our trade stop loss is at 5% in that specific scenario. So is a movement of price of 5% below our entry level. Our take profit is a move above the entry point of 15%. So we want to calculate how much in a spot position without leverage should be the calculation of our position size, that in this case become the most important parameter of our trade, to make sure that in case we are stopped out, we don't exceed our risk tolerance that we say is a 1% of the total account, and is $100 because the 1% of 10K is $100. So what is the calculation we have to do? If this 5% movement on the size we put should come out as a $100. So very simply put, in this case, the trade size of our trade should be $2,000, because if we move 5% of the $2,000, you will see that 5% become $100. To make it simple, 10% of $2,000 would be $200. So you divide it by 2 and you know that $100, 5% is your position size. So once you determine that this trade makes sense for many technical reasons, whatever, you should not start by the money, you should start by the technical reason, and you believe that this is a good entry because there is an order block. Here is a good invalidation for many reasons, and here is a good take profit for many other reasons. You determine this. Once your technical analysis gives you this setup, and should always be given by price action, technical analysis, and not money, nothing else but reasoning, then you will move these numbers that you get from this trade to your chart, and you will calculate how much your size should be in order to respect the $100 of your risk per trade of your account. In this case, my example is a 10K account. Then we start to open the topic of the leverage following this calculation. So remember that leverage was not invented to let you gamble or be degenerate more, because thanks to leverage you have a $100 account and you can play 100x leverage and gain more. If you play that game, you will blow up your account immediately and you will not have anything to trade with. Leverage was actually invented simply to allow you not to keep money in brokers or exchange end, because that is a very risky business. Brokers or exchange can fail, especially in crypto. We saw with Luna, FTX or whatever. You should not trust anyone with your money. So thanks to leverage, you can simply avoid leaving money station in someone else and keep it in a safe wallet. So in case you have a 10K total account, thanks to leverage, you can decide to leave 2K, 1K on the exchange, keep the rest of your money in a safe place, hard wallet, soft wallet, whatever you want, and play with leverage. That is the only reason leverage exists, and protect your capital, but still be able to trade and be active on the market. So what happened? For example, in this scenario, we decided to take the same exact trade with a 3-to-1 risk reward with a 5% stop loss and a 15% reward, and we decide to use a 10x leverage. In this case, we do the same calculation, but just that with the thanks to the leverage, we can reduce, let's say, the real size of the trade. So in this case, as you can see, the size is coming with a calculation at $200 by 10x is the same of $2,000. If we get the loss of 5% by 10x would be a 50%, okay? And 50% of $200, what is $100. If we win, a 10x 15 gain would be a 150 reward, that in the case of a $200 position, 150% become again $300. So it's simply the same with stamina at 10x. But the reason is you don't need to give at the exchange $2,000. You will just need to give to the exchange $200 to risk the same amount on your capital, that is 10K, to respect your risk tolerance of 1%, that should be $100, and you simply avoid with this leverage to give to the exchange $2,000, and you just give at the exchange $200. So in case the exchange fail, collapse, go bankrupt, you don't lose $2,000, but you lose only $200. Rather than this, leverage is completely irrelevant, okay? It's the same to taking this trade that I gave as the example, the 3-to-1 risk-reward trade with a 5% stop loss and a 15% take profit, is exactly the same doing it spot with $2,000 or doing with leverage with $200. In both cases, your stop loss will give you a loss of $100, that is the 1%, that is our risk tolerance of our 10K account, and the TP is $300 of the 15% of the take profit. To again use the very same example, if you use a 20% leverage, we will be able to reduce to 100 the position size, because if we get with a 20x leverage, 5% stop loss, it becomes a 100% stop loss. Now 100% stop loss on a trade that which size is $100 is $100 stop. A TP of 50% with a 20 leverage would become a 300% gain. That with a size of $100, 300% means times 3, it will be a 300% gain. In this case, just be careful with isolated leverage. That is not the topic of today. This trade would be liquidated because your stop loss is at 100%. So it means that if you are using isolated trade, you should never put your stop loss with the calculation of the size and the leverage above 90 or 80%. So in case you see that your stop loss with the leverage become more than 80%, you simply reduce the leverage to avoid the risk of being liquidated in the isolated future position. So I think this gives you the basic, super basic concept of trading and why risk management is important. So this is super basic. Now, the first question is, but what if we take multiple trades? So should I keep risking 1% per trade? The answer is depends. Personally, I always try to avoid to have more than total 4 or 5% risk on the market. So what does it mean? That if I take 4 trades and the market is favorable, whatever, I can take 4 trades with a risk per trade of 100%. Because if all the 4 trades will be stopped out, I will lose totally 4% of my account. This is very subjective. So I would suggest to try to avoid to risk more than 5% of your account in the market. So especially crypto market is completely, totally correlated. So even if you diversified with 4 or 5 different trades, it might happen that if Bitcoin dump hard, all your trade, if they are all longs, all that gets stopped out. So if you risk too much and if you have like 10 trade open with a 1% risk per trade, you will blow up in 1 second 10% of your account. As you know, if you lose 10% of your account, then you will need to win 11.1%. So my suggestion is never risk more than 0.5 to 1% per single trade, and never risk more than 5% of total exposure in the market. That is the sum of all your open trade and the calculation of the stop loss as we did here. What are the exceptions and the way to work around this concept? First of all is that your risk in the market, to my view, is adding when you are on the same side of the trade. So if you have multiple longs open, always make sure, especially if you are beginners, to add them. So if you have 3 longs open, consider that as a total risk you have in the market on the long side. What you can do is that if you have shorts, so means that if I'm risking this on this trade, but in the meantime I'm risking also this in this trade, something like this, these 2 positions could be not added as a risk. So the risk you are having in the short here could be not added in the risk of this one. Why? Because it's very unlikely, even though everything is possible, that both these positions get stopped out. It should be something like this. It can happen for sure, but they are not correlated. The stop loss, the 2 stop loss are not correlated. So you need 2 market movement. Let's say if the market is simply doing this, you will, yes, be stop lossed on this, but you will be taking profit on this. So these 2 stop loss, that is the pink part on my trading view, are not correlated. So whenever you decide to have multiple positions and some of these positions are long and some positions are short, try to think very well of what can happen in the market, but potentially you don't need to add the risk of this trade together. There are situations where you should do, but let's say as a rule of thumb, some or add only together as a total risk on the market, the long with the long and the short with the short. I would avoid to consider and to speak here about hedging, that in that case could reduce your risk because probably you do something different than the example here, but I would leave this concept of hedging on a second episode on risk management with more advanced criteria. The other concept that I want to share is the compounding. So the compounding means that you take multiple trades on the same direction. So something, for example, here in Bitcoin, something that might look like this. So you enter this trade and you decide that in this trade you risk 1%. You get filled, price move higher. Let's say that your stop loss is somewhere here. You are not yet at take profit, but you want to compound this and have more exposure to this trade. So you want to bid once again the price potentially do this and go up. So what happened that let me make it a little bit more simple for the calculation. Let's say that you get this trade with a 3%. And you get this second trade again with the 3 to 1 risk reward. So what happened? When you enter the first trade, you were risking 1% of the account to gain 3%, okay? Because we are using always the 3 to 1 risk reward. Now your trade goes in your direction and you say, look, I like the price action of Bitcoin. I want to add, but I don't want to risk more than 1% of this trade. So what happened? Once the price moves in your direction and you want to compound, you can simply remove the risk of this trade. So this trade now is what they call risk-free. So you are still involved in this trade. You have still the potential of gaining 3 because you were risking 1. And if you go 1 here, you will take a 3% account win. Now you can try to compound and put a second trade. This trade has the second concept. We don't have any more the 1% risk we had on the initial, so we can allocate further risk to a second trade. In this case, we do again 1% in this trade that will give us a 3% reward. So what happens? If the price really do this and it finally goes to our take profit up there, what will happen? and this is a very smart move to trade trending market, we will gain 6%. So what does it mean? That if both this trade will be going to take profit, so if something like this happens, we are not stopping the first one and then we go there, we will get the 3% of this trade and we will get the 3% of this trade. If our logic doesn't work and the price does like this trade will be stopped at break even, okay? And this trade will be stopped at 1%. So we respected our risk tolerance. We are not risking more than 1%, but in case we win, we will win 6%. So we compounded our entries without increasing our risk tolerance to the market. So these are very important concepts. What you can do is that you can calculate all these concepts simply in any trading platform or exchange. This is ZoomeX, that is the exchange that is sponsoring this video, and is a very super cool exchange. Is non-KIC, so you can just use the referral link you find in the description below to get a 20% on trading fees, and we run very cool campaign with gift and cashback. And you can see that whenever you take a trade, you fix a stop loss or whatever, here they will give you it will give you the calculation. So I don't know, now the entry price would be this is Ethereum, $1,828. If I say that my take profit is at 1,700 and my stop loss is at 1,900, here is showing you for the short that my win will be $622, my loss will be $315. The risk reward, since I think is at 30%, leverage position will be a 200%, and the loss, this will be a liquidated position because is isolated, is 119. Or the example of the short I have open on already on Ethereum, this is a 2.36 risk reward trade, where you can see that the entry was 1,827 or something. The stop loss is at 2%, with a 30% with a 30x leverage would be a 60% stop loss, and the take profit is at 4.83%, around 5%, with a 30% leverage will be around 150. So this calculation that I showed you in the file before are calculation that you can also do, also double check whenever you open or close, especially here in ZoomeX is very clear because it gives you all the data. Whenever you fill this, and you will understand the stop loss, for example, according to what is your account. Whenever you write the potential stop loss, let's say $1,900, you know if this $300 that you see here is actually your limit of risk tolerance. So if you have a 10K account, we say this is too much because it will be 3% of your account. So you don't need to do those calculations by hands, but you can then, once you see it's too much, regulate the position here and make it bigger or smaller to make sure that you respect, for example, the $100 level that we say. So for example, in this case is $64 because we reduced the size of the position. So in case you want to open position, make sure you trade with me on ZoomeX. You will find the referral link down below. But I think it's enough for this video. We saw a lot of concepts. So just to recap and focus on the most important concept, remember that risk management is fundamental, if not the most important aspect of any trading activity, simply because just with risk management you can protect your capital. Your capital is all you have to be in the game, to participate in the market. So if you blow or destroy your capital, you will be out of the game. Second, remember, the less you risk on a trade, the more losing trade you can have or losing streak you can have without burning too much your capital. So that's why we focus more on avoiding risk than making money. Third, the concept that risk management is usually very connected to your win rate and to the kind of risk-reward trade you take, and this will allow you to develop your broader strategy. Remember that you should not risk more than a percentage on each trade. The textbook rules is 1% of the total account risked per trade, but remember that if you take many trades, you should sum them, add them, and you should avoid to risk more than 4 to 5 maximum total risk of your account in the market on the same side. So if you have 5 longs, avoid to open more, because if each of these long has a 1% risk, you are risking, in case all the market dump, that you lose 5 or more percent of your account. Whenever you take a trade, the only important part is your stop loss placement before the taking profit. The stop loss and the taking profit should be dictated by technical analysis reasons and not by money. Once you determine this, you will move to the calculation of your size, because thanks to the size, you will make sure that you respect your risk tolerance and you will not risk more than what your rules are dictating you, and in case you are stop loss, you still risk not too much of your account. Leverage is just a tool to allow you to avoid to keep money on exchange. It's not something to gamble more. So just by using leverage, you will allow yourself to leave more money on the exchange or on the broker. That is the only reason. So the concept of risk per trade and whatever is the same. Just you will be able to use less size, because thanks to the leverage, you will be able to multiply the size you have on the exchange. Avoid liquidation and all these other topics. So I will try to make a more advanced video in the future about risk management, but I think this video is covering most of the basic topic. Whenever you take a trade, make sure to do it with me on ZoomeX. You will find the referral link for a 20% discount on trading fee down below in the description. And we see in the next video. But before leaving, make sure you subscribe, leave a comment and a like, and have this notification on. Trade safely, always applies a very strict risk management, and we see in the next video. Take care.